Well, welcome everybody to the March edition of Dashboard Diagnostics. My name is Mark Robertson. I'm joined here by Lori Fredrickson. Again, we do like to keep these sessions informal. If you have a question or you want to go somewhere during tonight's session, ours is going to be a little bit different tonight. For those of you that have been to many of these sessions, you already know the drill. What we typically do is take an existing investment club. Sometimes they will disclose who they are. Other times they will rely on our witness protection program. In any event, what we have found over the course of, gosh, it's I don't even remember how long we've been doing it, 2.5 years now, and we've been doing this on a monthly basis. We have never had a situation where we grabbed a portfolio, a club held up their hands and said, why don't you take a look at our portfolio, see what we can kick around. We have always managed to find some story or some lesson. We have had clubs like the Beardstown Ladies were here with us on Valentine's Day a year ago. Clubs literally from all around the country, anywhere from Seattle to Atlanta, to clubs out of Colorado, Arizona, a few of the Michigan clubs, a couple that I've written about here lately. And in fact, that kind of leads us into our opening slide here tonight. Some of you probably remember a year ago, I had forgotten this, but a year ago, March 10th, 2011, the club that we featured that night happened to be Lori's club. She's a member of the Northern Traders. And if you go back and actually look at the archive, the PowerPoint, and the recording from that program, we listed, obviously we displayed the portfolio and we talked about some of their favorite stocks at the time. And lo and behold, they went on to win the group prize. They were the top-ranked investment club participating in our Groundhog Challenge. So that is just so cool. I mean, you can go back and see exactly what stocks they were interested in, what they're thinking about. And in fact, they're back on top of the leaderboard for the current edition of the Groundhog. Now, for those of you that aren't familiar with the Groundhog, that is our pet name for our stock selection challenge contest test that runs from Groundhog Day to Groundhog Day every year. We've had 5 of these now. And it's just a lot of fun. Basically, individuals and clubs participate. You basically pick 5 stocks and try to be the best performing groundhog. Why Groundhog Day? Well, nothing special other than the fact that it's the day Manifest Investing was founded 7 years ago. So we're in our 8th year, 6th year with the contest. It's just something to have fun. So anyhow, the images that you see on your title screen are from that session a year ago, along with one other person there. That's Nick Strategos of Pittsburgh. Many of you in the Northeast and in the Better Investing Club circles know Nick. He's a volunteer teacher for the Pittsburgh chapter, and he was our individual champion in the Groundhog. We give a group award and an individual award going back for all 5 years, and we'll just have a lot of fun, and it's kind of fun to kick things around. What I thought we would do tonight is take a look back at the favorite stocks that were are being selected by this year's participants. We're still taking entries. We'll take them for a few more days if a club wants to throw their hat in the ring. But we thought we'd take a closer look at that portfolio. And yes, the chubby groundhog on the upper right is one of Lori's favorites. I think that's a groundhog. It's kind of hard to tell.
Yeah, it could be a beaver.
Could be. Anyhow, you guys know the drill. Here's the disclaimer. Lori's been talking about keeping all the legal types happy. And in this case, this is just our reminder that everything we do here is for demonstration purposes only. Any idea, any stock that you hear discussed should be treated as an idea for study only. Go study it carefully using the methods that we all know and love. And make your own decisions. So again, for illustration only, and no investment recommendation is intended by anybody here. Just a quick look at we're not actually going to take a look at a specific club tonight. I thought we'd just take a look at this Heavy Hogs portfolio for 2012, this year's contest. And what we've done is just want to point out that it's very geographically diverse. We have participants from all over the country. We may have a few international entries. We expect to have somewhere around 100 participants this year, very mixed from men, women, and clubs. And the clubs are also male clubs, all lady clubs, and some mixed clubs. But this goes back 5 or 6 years, and we've been very pleased in at least 4 out of the 5 years with the overall performance. We did have a year that was a little bit bizarre in that mix. Didn't perform quite as well, but the performance results of these particular stock selections is pretty strong in most of the year so far. This particular group, even though it's early out of the starting gate, has that's just a simple rate of return since February of 6%, and at least it's out of the starting gate in the leadership position, or in a very favorable position, because the general stock market since Groundhog Day this year is up a little over 3%. So we're basically looking at a decent relative return so far. So we'll give a mini standing ovation for at least getting out of the gate this year and rolling ahead. Here's a look at the portfolio. And again, what I thought we would do tonight is, and again, Lori is manning the question panel. If anybody has a question or comment on anything, what we'd like to hear is, what stocks would you like to take a look at in greater detail? I'll pick a couple to dig into, but if you guys want to, if you see a stock on this list that you want to delve into a little bit deeper, that's part of what tonight is all about. So kind of look down the list, and if you see one you want to go for in a little bit more depth, enter it in the questions tab or raise your hand and just kind of guide the discussion, manhandle the discussion into the stock that you want. As you heard before the session, Lynn Dyer and I were talking about Arctic Cat. That's the type of thing that we encourage here. Don't be afraid to point out a stock. We do want to limit it to the stocks on the screen tonight, but it's the type of thing we do at our Manifest Investing webcast. We're not afraid to go and take a look at a stock and dig in and try to understand the types of things that are important to study as we do study our stocks. So what we see here is the portfolio itself. In actually 6 short weeks, Buffalo Wild Wings has already shot up 30%. That's a stock that is, again, it's among the 16 or 17 favorite stocks of all the participants in the contest, but it's been a favorite in the community for quite some time. And we'll probably take a closer look at that one in terms of, how volatile has the price been over the years? Do we have to give that one kind of special consideration? And speaking of special consideration, I think entries number 2 and 3, maybe even 4, Apple has a special place in our heart. It's the second most widely followed company. I think Lori has pictures of Apple personnel and pieces of Apple all around her family room. She's definitely a fan. I don't know about the Coach. Do you have anything from Coach laying around the house too, or?
Oh, I had my Coach phase when I was quite a bit younger and had a job where I could use Coach purses. I have a closet full of them. They last forever.
Those were the days. Well, anyhow, those have been the 3 hottest stocks since February. And then those that are familiar with some of the stocks that we follow within the community, I've gotten a real big kick out of BioReference Labs because, it's a area of, let me just say, active debate within the community, and that's great. That's great stuff. But I really believe what we saw BioReference Labs become subjected to was a fierce attack of the short sellers in the 4th quarter of last year. A $20 stock price was reduced to something around 10, and it really was a stock under assault. One of the reasons that we pay so much attention to it is it's been selected at least 4 times in the Manifest Investing Roundtable that we hold on a monthly basis. We'll be holding here in a couple of weeks again. So, it was just getting beaten senseless by the stock market in general. So obviously there were a bunch of us watching it. And for entertainment and educational purposes, if you go to the Manifest Investing Forum, we'll probably demonstrate that too. If you go in and you actually search for the thread, I think there's 40 or 50 messages about watching what is known as a short squeeze. Lori raised some very valid points about concerns with the accounting practices, and just kind of, you talk about raking a company over the coals and subjecting them to some fairly intense scrutiny, all in the spirit of understanding better. And again, many of us come away with the conclusion that, boy, and they could be lying to us. They could be fabricating those beautiful results. But if they're not, this is a company that is firing on quite a few cylinders. So with that as an entry, those are the stocks that have done fairly well. Down at the other end of the scale, you can see that Massimo, Schlumberger, a couple others, $100 invested back on Groundhog Day is actually sub 100. Not too bad though, even under these conditions. these are the type of companies that that would really attract my attention, so long as everything over here is good. And we see decent quality ratings and projected returns. The fact that they're at the bottom of this list just means that they've been kind of sluggish over the last couple of months. And again, our mission as investors is basically to try to decide, are they sluggish for some well-founded reason, or just simply taking a breather? Some interesting stuff going on there. AeroVironment is a company that many of us were not all that familiar with. Ticker symbol AV. AV is shown here, and the company is involved in the manufacture of drones for the military and a few other things. So there's obviously some concerns about the strength of that business going forward. But a fascinating study, and a company that showed up on among the most frequently chosen by our Groundhog participants for this year. So there they are from top to bottom, the ones that are doing well so far out of the starting blocks, and the ones that have been a little sluggish out of the gate. Doesn't mean that they're anything to give up on yet, but just kind of raise in on them. Any questions or comments at this point, Lori?
Or people have given you a list of things they want to talk about, so I don't know if you want to take these in order, or...
Let's go just a little bit further, and then we'll actually take questions and figure out where we want to delve. Because I'm going to come back to the portfolio sorted by return here in a few minutes. Let's take them at that point.
Okay.
For those of you that may be new to these sessions, again, we take a club portfolio, any portfolio, and subject it to what we think of as kind of our core or primary diagnostics, and that is to establish, what are the overall expectations for the portfolio from three key perspectives. Those three key perspectives are the return forecast, known as the projected annual return, or PAR, and then the overall quality and the overall growth of the portfolio. What we're looking for with the projected annual return at any one time is to be 5 to 10 percentage points ahead of the market. The market right now is the median return forecast based on the 25 or 2,600 stocks that we follow is approximately 7%. So we'd be looking for a portfolio, in a dashboard diagnostics mode, to be in that 12 to 17 range. And you can see that this particular portfolio, very typical of a contest where everybody's trying to outdo one another, and you're basically going to see a little bit of fence swinging, but you can see that the portfolio is at the kind of the high end of the range. Most clubs would be at the lower end of this range, basically just trying to stay above this 12% most of the time. Certainly want to be somewhere in the middle of that target range. Quality, this is kind of interesting, because what this says is, even though there's people out there swinging for the fences, and I really believe this with all my heart, they've watched the results here for the last several years, and they know that you can take a company that is really of questionable quality, or really challenged operationally, and you can make a lot of money on it, but it's really dicey. It's really turbulent. Really, I'll use the word risky. What we find is that if you stick to the higher quality companies, you just simply raise the probability that you'll have a modest to generous outcome. And you can see here that the average quality rating, this is just kind of a wow factor. We typically want to be in the 70 to 80 range for the total portfolio. This particular portfolio is at 84, and that really is kind of a wow. By the same token, anytime you're trying to generate, not just long-term but short-term results, sometimes playing with the smaller companies, the faster-growing companies, is the thing to do, and that certainly is the case here. We typically would design a portfolio to be somewhere in that 11% plus or minus range, as is shown right here, and you can see that basically people are trying to pick up the performance advantage of operating in some of the faster-growing or smaller companies. And again, this is a bit of a walk through a minefield. You're dealing with some of these very faster-growing companies. They're going to be, for the most part, and generally, maybe a little more vulnerable, a little less stable in some cases, which also makes it amazing that the earnings stability of these companies is 76, because typically when you're dealing with some of the, call them emerging or very rapid growth companies, you can see some fairly low scores there. So some neat stuff. Kind of fascinating that the returns are that high, the quality is that high, and again, the growth rate is that high. Just to reinforce, the growth is coming from collecting a bunch of the faster growing companies. The thing that I would point out is the Russell 2000 had been on quite a tear going into the advent of the Groundhog for this year. So some of those opportunities probably are a little bit more tenuous than they have been in the past, at least for the next few months. I'm talking about short to intermediate term. So it'll be kind of interesting to see how this works out. And again, that's just Mark's opinion. Just a quick reminder as to why we do it in the first place. This is a little bit in response to my rant from earlier today. If you haven't read it, it's in my weekly message for today, where I'm a little tired of people telling us that what we do is not possible. When I sit around and I look at many of your clubs, and I witness levels of success that a lot of I'll just refer to them as academics, simply say it can't be done. It's impossible. It's not repeatable. And it gets a little bit annoying sometimes, so I ranted a little bit. One of the ways that we achieve this is by being willing to shop amongst the spectrum of all company sizes, and basically picking some small companies, faster growing companies, and blending them with the larger companies. And again, the last decade is shown there with the S&P 500. We know that to be large companies, generally slower growing, with average growth rates down in perhaps the 5 to 6% range, and it had a tough decade. That doesn't mean I'd bet against them today, but they've had a tough decade. They've basically been catching their breath for 10 years, and eventually there will be some real positive stuff there. At the same time, the value line arithmetic average, many of you already know this. This is our all of the above average that basically means it includes all of the above, some small companies, some medium companies, and some large companies. As we like to share, one of the reasons that our methodology works is because of that distribution of small, medium, and large, getting some faster growing companies in there with those more mature stalwarts that by design, by natural characteristic, grow a little bit slower. So again, that blend is so important to have small, medium, and large. It's one of the, as it says at the top there, it's urgent, in our opinion, to make sure that you have small, medium, and large. As you're sitting around the fireplace these days wondering where some of your investing colleagues are directing their attention, this is kind of an interesting chart. It's the sector diversification from the heavy hogs, the 17 most frequently chosen stocks for this year. And you can see that there's been an awful lot of interest in technology stocks. Healthcare still remains up there fairly strong interest in discretionary, but those three do represent, 36, almost two-thirds of all the interest in the stuff out there. I'm a little bit surprised that we don't see a few more financials. I think portfolio recovery is the one accounting for that. This month's cover story in expected returns, our newsletter talks about the notion of how much is too much. And if you're not familiar with some of our thinking, and again, some of it is forming, Cy Lynch and I had a fascinating conversation about how much is too much. When it comes to technology, I don't think, based on the current analysis of the technology sector, that 36 to 40-ish% is not too much, but there is a point where it would become probably too much. And it kind of came out of a debate where some of our favorite clubs were debating, well, shouldn't we have limits like, thou shalt not invest greater than 20% in one sector like technology. And again, I think you have to look at the bigger picture, the typical ranges over the years, and we did include the ranges for a few sectors in our cover story. Just want to give that some thought, and my answer is 36% to me is not too much, but only so long as it deserves it. What I mean by that, if you go back 10 years ago, you take a look at a very heavy weighting in technology back at that time. If you really dug in deep and looked at some of the return forecasts, one of our favorites to point out was our clarion call on Cisco Systems when the projected return for Cisco Systems went sub-zero and went down to as much as minus 10%. Again, if you've got a 40% slice of your pie, that is stacked up in companies with projected returns of -10, I would argue, and you're not going to win this argument with me, you're really hanging out there, in danger of getting hurt. And those people who stayed in technology without heeding those return forecasts, some of us did get hurt pretty badly by that, what happened 10 years ago. Just a quick reminder of how we look at all companies at Manifest. I'm not going to spend a lot of time on this, but those of you that may be new to Manifest and Vivio, we do encourage investors to study the companies, form a vision of what the company has looked like over the past 8 or 10 years, embed or incorporate the analyst estimates for a couple of years, and then build some type of a perception of what the long-term trend, both top line when it comes to sales and bottom line for earnings, what does that look like for the company under consideration. And again, we do embed a couple of years of forward-looking estimates for all companies. Again, for those of you that were here early, and Lynn, this is what I was talking about. When we embed the forecasts for Arctic Cat, as we were talking pre-session, that's basically gonna do kind of a tug up on all the expectations and probably make a step change difference in the return forecast for a company like Arctic Cat. All right, here's where we basically want to dig in a little bit. We'll take a look at the questions that Lori has and take it from there, but this is the portfolio sorted by current return forecast in that final column. So all of the stuff in the final column is sorted from most attractive to least attractive right now. Many of your eyes are drawn right to the bottom of that chart, so I think we'll start there and then we'll go from there. Buffalo Wild Wings is up 30% in the last 4 to 5 weeks. And what has happened at Buffalo Wild Wings is even with some bolstering of their fundamentals on which we base the forecast, the projected return is now down in low single digits. So it is the type of stock that I would urge people to really, as individuals or as clubs, give some thought to, should we be protecting ourselves a little bit? And if you don't have some type of protection in place, just simply having a huddle and saying, okay, we're aware that this thing can really hit speed bumps. And I would like to show the speed bumps for Buffalo Wild Wings just to make the point that that they do happen. And then we can go wherever you guys want after that. I really like using Buffalo Wild Wings as an example because this is one of the stocks. In fact, it's probably the poster child stock in our family for I'm going to stockcharts.com. I'm going to look at a fairly straightforward chart on stockcharts.com. This is a free site if you want to explore it and learn a little bit more about it. Those of you that are familiar with stockcharts.com will see that I have embedded a relative strength graphic up at the top. I tend to look at long-term charts whenever I'm doing this type of stuff. And what you can see here on stockcharts.com for Buffalo Wild Wings is the severity of the corrections that happened on the stock. It went from 45 down to 15 or so. Here's another case where it took a dive from almost 60 down to 40 fairly rapidly. So you can see these fairly significant, call them speed bumps or whatever you want to call them. And again, going back to what I mean by poster child, for years, since the early days of the investment club, we did an awful lot of buy and holding and gritting. And what I mean by gritting is literally gritting our teeth. There were times when we had stocks like Buffalo Wild Wings where we had a lot of faith in the company, really had a good understanding of the company, good long-term expectations for the company, but we knew it was probably overbought. The price had been run up at certain times during the cycle. And then about, 8 or 10 years ago, we got the bright idea of why don't we sell Buffalo Wild Wings every time our stock selection guide tells us to sell it? And everybody out there, go ahead and feel free to hit your forehead. And what we proceeded to do was, and this was in my family club, in our family club, we bought Buffalo Wild Wings at conditions like this down here around 20, sold it at 40, and then bought it again back down here, sold it again up here, and we did that 2 times over a 5-year period. Again, that's not frenetic selling. It's certainly not day trading. But what we found is our returns in doing that, and not just simply gritting, Gritting, gritting our teeth and riding out that roller coaster, it just turned out to be such a powerful experience. And again, the message is, anytime you see a projected return that's sub-zero or zero or down in low single digits, it's okay. It's okay to exit the party, and even in this case where you see a considerable amount of momentum for Buffalo Wild Wings. And again, I would encourage you, if you decide not to pursue some type of protective action, if you happen to be in one of those investment clubs where people stand on their heads until they get the particular studied stock out of the sell zone, that sort of thing, I would just say grit your teeth and be careful, but make sure you hug and all that kind of stuff. And no kicking of the family dog if things turn sour on you. So again, that's just my example, kind of my story of what a powerful difference it made to buy and sell that one a couple of times. And by the way, it's back in my wife's IRA, and we kind of forgot to sell it this last time. I think probably this one right here, and she's kind of happy we forgot this time. So she says, "Heck with all your gritting. I'm just happy with what she sees happening in her IRA." So with that, let's go ahead and turn it back. Lori, do we have any specific areas of interest that we would like to go into?
Yeah, there are a couple, but just with regards to what you were just talking about, somebody was asking was how old the value line is that you were using for the projections, and if you know if their earnings estimates have gone up since then, or if you know when the next value line about them might be coming out.
Okay, let's go ahead and look. I'm going to go to value line. Going to grab I happen to have a subscription to the Investment Analyzer. So let's take a look. Buffalo Wild Wings. Can see that this is based on and more important than the date, actually the stock price is more important. A stock price of 86, which is not that distant from where it is right now. What was that price? Price is 89. So this is actually fairly close. And what you want to look at and pay attention to, and again, this is a message we've been repeating many times over. The low return forecast from Value Line is what we like to draw people's attention to. And you see here that basically Value Line, based on this, we'll look at the date here in a second because some of you just have to have that. It's fairly recent, but they're basically seeing a return forecast of 0. And again, that says low, but our statistical research, and it's some fairly in-depth research, we look at every single company, and we're now going back many years. We think that the low total return forecast, again, it's annualized and it includes dividends, from Value Line is the best number you can look at for a second opinion on any company. And with one caveat, the one caveat being it generally should be thought of as a single person's opinion. Now, I know at Value Line they huddle in teams, they have committees, they do quality control reviews and all that kind of stuff, but this generally does tend to represent one person's opinion. Now, at Manifest Investing, we take not just the Value Line forecast, the history and the forecasts that are given, but we blend them with forecasts from places like Morningstar, Standard & Poor's. We pay attention to the analyst consensus estimates as we build our consensus viewpoint, so those will be factored in. There are a few times, and I try to point them out every once in a while in the weekly comments, there are a few times when the Value Line opinion or result or outcome is fairly substantially different from the folks at Morningstar, S&P. And my experience over the years has been that, especially if the company is a little more volatile, I really like to know what S&P thinks. They tend to have a little bit more experience with cycles and sensitivity to cycles. So in the case of Buffalo Wild Wings, we're talking about a report issued by, again, one person's opinion in this case is Matt Spencer. Don't know Matt, but I'll bet Matt is a bright person. And issued on March 2nd, so it is not that old. The other thing to keep in mind when you're looking at a return forecast on Manifest Investing, it is price corrected. So the change in from the price of 86 at the top of the page here to the current 89 is accounted for in what we do as we take a look at the universe of stocks. So you are looking at fairly current information on Buffalo Wild Wings. I happen to know that that the consensus influence of Morningstar and S&P, they're actually even slightly more bullish or favorable on Buffalo Wild Wings than Value Line is. So that actually influenced that up even a few percentage points. The reason it's back down close to zero is the stock price has gone up $3 or $4 over the last couple of weeks. So does that, I think that probably answers that question. Do we need any more follow-up on that, Lori?
I don't see any, not on that particular one.
Now, some of you are probably wondering, you know, Mark, what would you do in this situation? And again, you have to make this call on your own. You have to understand the situation, do some homework on this. I have actually been contacted by a couple of this year's Groundhog participants, including my son-in-law, so he kind of has the hotline. My son-in-law has Buffalo Wild Wings in his Groundhog portfolio, and he's actually issued the question. He says, you know, why should I be thinking about some type of a trailing stop order, limit order, or some type of downside protection, because this thing has gone up so much since February 2nd. You know, should I be looking at, you know, and he's also looking back. I mean, just look at the price chart that you see here. He's looking back and saying, wow, there were some really big haircuts here. And sometimes those haircuts happen pretty quickly. And is that something that as investors we can protect ourselves from? In the case of a Buffalo Wild Wings, I would make the case for it's the type of company that I think it's easy to not fall in love with. I mean, I love the company. I mean, I'm not sure I care for the food so much. I mean, I've witnessed our son and his armada of football colleagues, you know, demolish a Buffalo Wild Wings. I mean, a lot of people love it. A lot of people love it as a great sports bar. It's not the type of thing that I necessarily understand or like that much, but I do really respect the type of operating performance that they're turning in. Having said that, I really think this falls into the class of stocks that many of us are really a bit uneasy about. You know, think of the teen apparel type companies. You know, if Buffalo Wild Wings does have a moment, a nasty moment, it really will take quite a haircut, quite a correction. So it can make sense to do a trailing stop order protection on this type of thing. So what you literally would be doing would be trying to protect your gains. I'll go back to the stock charts. What you basically would be doing is saying, look, you know, kind of going back over time and saying, well, when did this thing fall apart, and take a look at some of the trends and basically say, I'm willing to get out of this if it drops 10%, 15%. What we will probably do in the Groundhog Challenge folder at Manifest is post some of my son-in-law's name is Nick, and post some of his comments and urge any of you who have a lot of experience in establishing trailing stop limits to express your opinions on, you know, how should you think about this, you know, how would you want to set it. You obviously don't want to set it too close for a volatile stock because you'll get stopped out of it, and but you do want to provide yourself with a sufficient protection to protect against those haircuts or speed bumps. So just kind of a thing that's being kicked around. And again, coming back to the portfolio itself, you know, again, if this were a real portfolio and we were talking about it in a traditional dashboard diagnostics session, Buffalo Wild Wings, by virtue of its low projected return, if the portfolio needed it, would be a candidate for sale to generate proceeds to purchase something with more attractive return characteristics. Where would I like to go next, Lori?
Well, the first question we had was somebody, Don Leno wanted you to take a look at PRAA maybe.
Okay, portfolio recovery, that is a stock that has come up fairly recently in several discussions. Probably the best way to just demonstrate here real quick, what I would encourage anybody to do, for those of you that don't know about this, go to Manifest, type in your ticker symbol. In this case, portfolio recovery is PRAA. It's a stock that's been picked for the roundtable a couple of times, if memory serves me, and it might not be serving me real well right now. I've been really harried here over the last few days. I'm pretty sure that Ann Manning and Ken Kabula both selected portfolio recovery for the roundtable portfolio. I'm pretty sure about that, but we'll find out here in a second. go to the page on portfolio recovery, and you see this little hourglass here that Kurt has provided us. If you click on that hourglass, you are taken to PRAA specific entries, whether they're forum posts or articles. And in fact, you can see right here from the roundtable, it's a session with Ann. Don't know if Ann's here tonight, but Ann is one of our damsels that has participated as a guest, and she's knocking it out of the park. Between her and Kim Butcher, they're doing a fine job. And here you can actually jump in and take a look at some of the analysis. The PowerPoint presentation on portfolio recovery is right here. She's actually included a stock selection guide if you want to take a look at it. So there is an opportunity to do that and dig in a little bit deeper on portfolio recovery. You can probably get to, again, you can just kind of look down the list. These are all posts. There haven't actually been any articles. Let's take a look at, this would be from approximately a month ago. In fact, I think I'll just use this for now. I mean, this obviously, at least obviously to me, is why there's such community interest in this stock. What you're looking at here is the business model or the visual analysis, taking a look at the sales profile for portfolio recovery, and the bottom line earnings profile, again going back from 2011 back to 2004, but then also embedding these estimates for 2012 and 2013. You can see that the analyst estimates are strong going forward. It's a very attractive picture. You can see that for whatever reason, the company suffered a little bit of a downdraft during the Great Recession back in 2008, 2009, which is kind of interesting because this is a company that probably capitalizes on opportunities that are created by Great Recessions and those type of speed bumps. But anyhow, this is the type of look that we do for all companies. We see a company growing, again, at robust upper teen growth rates. So again, you can kind of kick that one around and take a look. It happens to be a company that is not in the Value Line Standard Edition. We'll go ahead and take a look. It's in the Expanded Edition. And what that means, and for those of you that are familiar with Value Line, you see this looks a little bit different. This is the small and medium-sized company edition. You can see that there's a little bit less forecast information on the company. We do use the financial strength as one of the components of our financial strength rating at Manifest. You can see that it's a B++, but as you can see here, you don't have the same 3 to 5 year forecast for the companies that are not in the standard edition. So again, the picture that you were looking at back here does reflect the historical data, but then it also incorporates the analyst consensus estimates for the company. So again, it's a fascinating read. You can go in and look at the YouTube video from that night and see what other people had to say about it, and just encourage you to do that. And as you can see, it's right at the top of the list. Highest par, pretty high quality, well-managed company. If Ann is here, she might have some comments on her research. Ann, are you willing to? I thought I saw her name a few minutes ago.
Yeah, she's here. There we go. Ann, I unmuted you.
I'm here, but I don't know that I have anything else to say about it. I just think it's a really good company.
Well, that's because you taught me well. Any highlights that you remember from me digging into it? Anything that you discovered that might be of interest?
The thing that I remember is that their rate of return on when they buy something, I think it was like they buy something for 10 cents, they make 20 to 30 cents on it.
It's a pretty good return.
Yeah, and that's pretty good. That's, at the moment, it's the only thing that's sticking in my head. I've been keeping a 3-year-old today, so I'm a little tired. So
we should compare notes.
Okay.
Last time I'm married, and it wasn't a 3-year-old.
But that's the only, at the moment, that's the only thing that's stuck in my head.
Well, that's good. Thanks, Ann. And again, thanks for your participation in the roundtable. And I really wish you'd quit crushing me on the results side.
I'm sorry. I'll try to do better.
No, just keep crushing. You're doing fine.
Okay. Okay.
All right. Anybody else have any place they'd like to go and talk about any one of these companies? Any concerns? Anything that you'd want to share that?
Mark, Butch Lang was asking about Melly.
What
Libre.
He usually has a microphone. Maybe Butch could be unmuted.
Butch, do you have a microphone?
I do. Can you hear me?
No.
How are you doing tonight?
Very good, sir. Thank you.
You guys keep throwing these non-standard edition companies out there, so we don't have quite as much forecast help. But go ahead. What's on your mind?
Well, we try to mine for small caps when we can, and we do have a balance as you've referred to before. But when this came up, I think I was first exposed to it maybe on the round table, or at least one of the other manifest forums, or from Bivio, one or the other. But our club has bought this and done reasonably well with it, and quite well with it, in fact. So, but it's not a lot of information out there, so I'm just kind of polling the community here to see if anybody else is following it, and see what other people have to say about it.
I did notice just the other day, Butch, that there was what seemed to be a fairly interesting Seeking Alpha article. We might go there and take a look. If there's anybody that actually reviewed that article and has a Cliff Notes version of it, I'd be glad to hear it. Again, this is a company that we have brought up a few times. I have selected it in a number of venues, including the stock panel, the stock talk panel at the National Convention for Better Investing. You can see that it actually showed up as our Solomon Select. That's our featured stock back in the summer of 2010. And we actually made the point that, exciting growth prospects here. You can see that the growth is quite high. Profitability was improving and quite high. The thing I remember about it is the impressive potential of the scalability of the business. In other words, they could expand the business without expanding the infrastructure. Basically, any incremental revenues that were gained kind of flowed straight to the bottom line. I know I'm overgeneralizing, but just very powerful scalability. So this was the article back if you want to take a quick review of what caught our attention back in that time frame. One thing that we might talk about here, Butch, is as you're selecting companies for a portfolio such as this one, people often ask me questions about, well, Mark, my God, this is a company with a 30% growth rate. And again, keep in mind it's a relatively small company in a fairly explosively growing area, but still that's a huge growth rate. And not only that, the projected PE is 39. So that growth rate and that PE to achieve that projected return. So again, my favorite way to describe this situation is think of Olympic diving. And you can either do a real simple straight dive into the water to achieve your score, or you can do one with 2 360 turns and toggles and flips and all that kind of stuff with a very high difficulty factor. And this is a company that in order to make its dive and successfully achieve that return, they got to hit it. They got to hit that growth rate. They got to hit that projected PE. So for many people in our community, and there's nothing wrong with having it. There's nothing wrong with having one of these. It's just you go into it with the awareness that, boy, if they ever miss one of those dives, they're gonna pay the price and probably see quite a correction. Having said all that, my God, this is a company that, my gosh, has really done well. We'll put up the longer-term picture. You can see they suffered with everybody else through the Great Recession. You can no longer hide outside the boundaries of the United States during a recession. We're all connected. It's one big, whatever Mr. Friedman said, the world is flat. But this company has really an impressive track record over the last 4 years. It's one of the best stock selections made at that particular national convention when I picked it. Some really neat stuff. Let's go ahead and take a look at back up to to look for some of the references. I'll tell you what, let's just go straight to Seeking Alpha. For those of you that are not familiar with Seeking Alpha, I'm just going to dive into this particular article just to jump into Seeking Alpha. And then switch to, I like this kid, he writes some good stuff. Tim McAleenan. I don't know why I'm having trouble here getting my keyboard to cooperate. Apparently it's got something to do with the advertising on the site. And again, if anybody out there has actually dug into the article I'm going to go to, this is the one that comes to mind, Butch. I have not read it, and I do not know Pablo, but it's the type of thing that I would go in with, you know, a fair dose of skepticism, not knowing who Pablo is or what his agenda. But my reaction when I got it on the email feed was, that's one I want to go back to and really give some thought to. And again, I have no idea about the quality of the article. It's a good title, though. Good title. And he seemed to have some concerns about some of their methods. And again, I would study that. But the important thing here is go to seekingalpha.com, enter your ticker symbol, and then look for articles that can be informative. Go there with you know, the cautious mind of a detective that is skeptical. There are people here that write articles to reflect badly on companies. There are some very good columnists that show up here. So again, just go into it with caveat emptor as you read your stuff. But that's definitely one that I would take a look at. You can see that they obviously had a good quarter end of last year, and the stock price reflects that. So when it comes to Mercado Libre, take away those major takeaways. It's got to hit the dive, and it's a very high difficulty factor, but very, very rewarding possibility for the company. And then take a look at some of those type of articles to give you some background on perhaps some of the challenges that the company might be facing going forward. Good business model. Everything that I wrote about in June 2010 seems to be intact, at least so far.
We bought it in August, and it seems to stay under the radar.
I would agree with that.
And, you know, and how do you actually pronounce that?
It's actually Mercado Libre.
Okay.
So, free markets. And for those of you that aren't familiar, I believe it could be characterized as the Latin American version of eBay. It's probably the quickest way to think about what it is. All right. Lori, anybody else want to kick one around? We've got a couple minutes left here. We've illustrated some of the interesting concepts of where to find some information, but we never know what people might kick up.
Just go back to PRAA for a second.
Sure.
Jean Ron is asking if you have any recommendations if your club doesn't want to consider it just because of the kind of business that it's in.
Well, if the club really just can't warm up to it, I mean, it's a tough situation. One of my favorite ways to tackle something like this, well, in some cases I do know of people, and sometimes this doesn't work out so well. They actually conceal the identity of the company while they perform the study, and then it's like a gotcha moment. Now, to me, that just doesn't seem to work so well. I have been involved in situations where I can remember vividly, and many of you have been around long enough to remember Clayton Homes before Berkshire Hathaway bought it. In our investment club in Chicago, I mean, there was just no way. The company could have been the best purchasing opportunity in the history of man. I'm not sure they'd have gone along. And there was just this aversion to, buying this company that makes trailers. And they made manufactured homes. And it was and they made them well, and they were good, and there's plenty of competition. I understand all that. But, I would encounter these arguments that, and boy, I hope none of them are in the room tonight. If they are, they'll hope they'll forgive me. I would encounter these arguments. Yeah, but what happens to them in a recession? They're going to get creamed in a recession. And then we would put up the chart, the stock chart, and with the recessions on it, and say, guys, if I didn't know better, looking at that recession, I think they've done pretty well in recessions. And the fact of the matter was that, in fact, the founder of the company engaged with our community and the audience and explained specifically why that was the case. And they kept saying, what if a recession hits? And my answer was always, well, look what happened the last 2 or 3 times this company endured a recession, and how they capitalized on opportunity, and how they scooped up businesses that were badly damaged, that they basically strengthened themselves at the expense of others during one of those corrective recessions. Anyhow, nothing that I could do would bring the club along, so we did what many of you do. We went and bought it in our personal accounts. And I still haven't forgiven Warren Buffett for the price he paid for it, but we appreciated being bought out at a pretty decent premium to what we originally bought. So my advice is, all you can do is make the best arguments you can. Try to remove as much emotion as possible. There are going to be times. I mean, and some of them are just again, you are who you are. I can remember helping start investment clubs that were based in the basements of churches, and they certainly were not going to buy, Anheuser-Busch or Philip Morris, and I get that. Now, there's plenty of stocks to invest in out there, and they just couldn't bring themselves to do that. I understand that. That's the choice that they make, and then nobody within that club would have been advised to try to change their minds.
Yeah, I think it's really important to keep in mind that there are a lot of companies out there, and you can put a portfolio together with not all that many companies. So if you just don't agree on one in a group, there's a lot of other options. Everybody doesn't have the same portfolio to be successful.
I'm with you, Lori. I'm to the point of allowing it to become divisive. You don't need to do that. There's no reason to do that. Just move on.
I think one of the fascinating things in these portfolio contests like Groundhog is the different portfolios that do pretty similarly, that have pretty much different stocks in them. It's really good to stand back and think about that sometime if you get obsessed over having to have something or not have something.
One of the things I thought I would also do tonight before we sign off is make sure everybody understands where they can go to kind of follow along. If you go into Manifest Investing and you go into the forum, get ready to take your bow, Lori. If you go into the Groundhog Challenge folder within the forum, you can see that we have the scoreboard listed here at the top. You can go back and look at last year's results too. But here is the scoreboard. And if you click on the 2012 scoreboard, we'll see who's in the #1 spot after today's hot market. It's loading up all the dashboards, and you can see that, again, the ladies are at the top again, with the exception of Dan. Dan is always near the top. He's up there again, too, between him and Nick from Pittsburgh. So Diane Brenning is at the top of the leaderboard. Let's see what Diane is leaning on. Diane has, of course, Apple, Oracle, Qualcomm. She's very, very tech-heavy. She has a fascinating company I'd never heard of until this year's Groundhog. You can see that we don't cover it yet, but ticker symbol FIO, Fusion IO Inc. You can see that one's accounting for much of her strong performance. So you might want to dig in to see what you can find out about that one. This happens to be last year's champions. Take a bow, everybody, including Lori. They basically have the same, pretty much the same companies. Did you make any changes year to year, Lori?
No, we just rolled it over.
So they rolled it over, but they didn't do that mindlessly. I know that you guys had a number of discussions about whether you wanted to keep all 5 of them, right?
Yeah, we did. But we just thought they seemed pretty good to us. We liked them.
Yeah, and I've heard the stories on basically all of these. Really good stories. Are you guys having any discussion? Do you own Buffalo Wild Wings in the club itself?
No, that's one we don't. We did really well on Chipotle a while ago, but we haven't really gotten into Buffalo Wild Wings.
So that's an opportunity for discussion, and see if you guys want to lock something in there. Might want to follow along with. I'm sure the discussion on trailing stops will erupt on our thing. But anyhow, you can go in and see how anybody's doing. And by the way, the Challenge Club, which meets a month from tonight, for the first time in the last few years, is on the leaderboard. And here's the consensus selections made by this year's Challenge Club participants by vote, and not too bad. I hope the club manages to stay there pretty well over time. So again, if you go in and look for the scoreboard, you can take a look. Now we do have a couple of guest rhinos, professional investors, Wall Street either institutions or analysts. Ken Fisher, he was up at the top until fairly recently. You can see that Ken Fisher's selections are obviously quite a bit different. Look at the quality ratings. Look at the projected returns. He's doing a lot of stuff outside the United States. There's a lot of non-domestic stocks, but you can often find an interesting idea. You can see that he's got, I know Julie Werner also has Devon Energy, and she's in the number 3 spot. There's Devon up at the top of his and doing fairly well for Ken and Julie. And an Italian Finmeccanica stock that's done fairly well for Ken Fisher this year also. You can also see Whitney Tilson, who finished near the top for the Rhinos last year. And then a number of investment clubs. And again, we had strong performance from investment clubs last year, and certainly out of the blocks, starting very strong again this year. Bauer City is always in the running, has been for the last 5 or 6 years. The Wolves are another repeat champion. Just an opportunity for some good, clean fun. And by the way, there's our champion from 2 years ago, Ann, who you just heard from a few minutes ago on portfolio recovery. So some good, clean fun. Let's see what Ann's actually kicking around these days. Well, she's in with Apple, too. So you have a lot of Apple advocates around here. Apple, ResMed, Quality. Again, these are all very much community favorite stocks. Again, portfolio recovery, but I'm be willing to bet that she's okay with it being down a little bit, and very favorable outlook there on the right. So you can find those, and we will do our best to keep those up to date. The changes that we've made to the dashboard system make it quite possible. And just to really show you how humbling this business is, you notice I have scrolled down 3 or 4 or 5 pages to get to me, and I'm actually hanging out with Hugh McManus down at the wrong end of the list right now. So, ouch. Talk about piling on, you guys. All right. Anything else anything that looks like we should kick around here for the last minute or so, Lori?
I don't know if you want to talk about Walgreens tonight. Miriam Douglas was asking if Walgreens does buy out Rite Aid. I don't know if that's a new rumor or something, but and they need to use debt to do that. Is it possible that that would be a reason to consider selling Walgreens?
Okay, it's a great question. I mean, it's certainly not a new rumor. I think both CVS and Walgreens have looked at the prospect of buying out Rite Aid. Rite Aid is really kind of a distressed operating situation. They do happen to own some very nice locations. I think part of just the general knowledge in the business knows that Walgreens, much like McDonald's, much of their corporate success over the years has been a tremendous skill at the real estate side of things, of location selection, independent of whether they own the spot or whatever. Their placement is very strategic. I actually worked for a management consulting company where I got to see up close and personal how strategic, and it really is pretty cool. I mean, from traffic patterns to demographics to the willingness of people to turn left, you wouldn't believe it. And basically Rite Aid did sneak in and get some of those prime locations also. So, you basically have the companies like CVS and Walgreens that see fairly considerable strategic value in those. Is it okay for Walgreens to use debt? My knee-jerk reaction is absolutely. They're really good at what they do. They're probably really good at looking at the return on the investment of something like going after at least a piece of Rite Aid. Looking over the years, you can see that the company, from a long-term debt standpoint, has been relatively debt-free until the last couple of years. And you might want to dig in and take a look at, what type of interest rate are they paying here on their bonds. You can do that either at Morningstar, or you can simply take this 70 and divide it by 23.96, and I'll do that on my little trusty little calculator here, just so we know. And what you see is that's about a 3% interest rate on the current long-term debt that they have. That's pretty attractive. So whatever Walgreens is doing, Miriam, I think you're absolutely right to bring it up and study what they're doing. Could be disruptive, could be unsettling on a stock price that has already been unsettled and disrupted for a period of 5 to 7 years. All things to think about. I would encourage you to perhaps read some of the stuff at Seeking Alpha, or if you can get a hold of brokerage accounts. E-Trade has great brokerage accounts, brokerage research reports. S&P one for sure. And then they also have, I don't remember the other one off the top of my head, but they have other research also available at E-Trade.
I think it's going to depend on what the fair value of the Rite Aid assets really are compared to what they pay for them too, whether that would throw things out of kilter in terms of whether they got it for a good price or not. That's probably what's most important.
Yeah, and anytime you have such a, I don't even know what words to choose here. I mean, they're in exactly the same business. So there's going to be times when a Rite Aid is right across the street from a Walgreens, and they probably have to look at divesting. There can't even be requirements to divest some of the acquired assets, and Lori's the expert on all that. Maybe we'll bring her back. We'll do this at another time, but talk in greater detail about the intricacies of what a company like Walgreens has to go through when they acquire assets like a Rite Aid. But it's a good study, and you know, for a beginning investor, probably reason enough to take a step back. Certainly not add anymore, but just kind of watch. If you've got a little bit more experience and want to dig into some of the gruesome details of watching sausage being made, you can get in a little bit deeper. And again, what you'd be watching for is, it really comes down to a very common sense, instinctive question: would Walgreens be overpaying for those assets that they're acquiring?
Right.
That's what it comes down to.
You know, probably a quick and dirty way to keep an eye on that is just to see how much goodwill they book if they did that. If they bring on a whole lot of goodwill, that means they paid quite a bit more than not the book value, but the fair market value of what they got.
Right.
So the question is whether that would play out or not, or whether you thought that would play out okay.
It's worth it. And again, Miriam, if you want to follow up in a little bit more detail on that, make a post on the Manifest forum, and we can kind of kick around some references on it and see if we can form some type of opinions as we see what's going on. Again, I wouldn't characterize it as a new rumor, but it did get a refresher. I know within the last week or so I've noticed a little bit of correspondence on that potential. So with that, we're at just a little bit over an hour, and I think we've covered a fair amount. Hopefully the ideas in the Groundhog portfolio have given you some ideas on stocks that you can go out there and study and see if they make sense to you and your portfolios. We do wish the Groundhogs collectively all the best of luck. I do expect to be higher on that list by the end of the year, or I'll be sad. You know, and I want some of whatever they're drinking with something in the water up around Traverse City, Michigan, and some of the other areas right here in the mid-Michigan area also. Some excellent stock picking going on, and don't leave me behind. Keep me involved in it too.
Yeah, Bill Thompson was asking if I had looked at BioReference Lab anymore since our latest quarterly report came out, which I have. I've been buried in taxes, and I'm aching actually to look at that because it's much more interesting, but I haven't really had a chance to do that.
Well, I know you won't let go of that one, so I look forward to you catching up with that someday and giving us a little bit of a briefer on, you know, do they seem to be behaving better, you know, in your opinion? Look forward to hearing that from you.
Yeah, I really want to follow up on some of the things I was looking at before.
All right, I'll just close with one last slide. I had it up here earlier. For those of you that are familiar with our tin cup model portfolio at Manifest Investing, you know that it's a 401k emulation that goes back a little over 15 years now. That's not a lot of time. Investing the maximum amount into a 401k that is stock-based. The reason I bring it up tonight is just for those of you that have been watching along with us. It's in our monthly newsletter every month. We are getting real close to the $1 million moment. Tonight we closed at north of $990,000, and what this represents to me, and in fact I've been meeting with a number of organizations and people about just this general concept or thought. I mean, this has been done with, you know, stock transactions that have been reported every month for the last 8 years, and then we can document them going all the way back. Someday I'll probably be asked to do that for something. But every single transaction documented every month going back since we began Manifest Investing. This was actually inspired by Dan Hess. But the really cool thing is, you know, if you think about the actual real life situation of somebody in their mid 40s, maybe early 50s, that thinks that, you know, gosh, I've only got 15 or 20 years left, what could I possibly do? This is a pretty powerful demonstration that you can still do pretty well. Even more powerful, if you're talking about a room full of 20, 25, 30, 35-year-olds, you can somehow find a way to set aside a decent amount of money into their 401k or 403b. Some pretty neat stuff. So anyhow, I get kind of tingly when I think about the fact that we're coming up on that. I realize it's just a number. You know, relax, calm down, Mark. But $1 million just has that kind of special feel to it. It'd be really fascinating to see how quick it hits 2 million. But just bring that to your attention. Be watching along. I'll be posting probably jinx it. It'll get up to like 996 and go back down to 800. But we'll run that risk. But just thought I'd bring that to everybody's attention and ask you to kind of watch along and everybody raise a glass if we get there and when we get there. So with that, I think we'll go ahead and close down. Thanks everybody for attending. Hope you enjoyed it. And thanks very much for your help, Lori.
You're welcome. Thank you.
Everybody march forward. Have a great time out there. Everybody be well. Thank you.